Welcome back to Alpha Recap. Thanks for joining us. Markets were closed for the day when we recorded this, and we're walking through what happened after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. So what really stands out here is that yesterday felt like rotation over a full-blown sell-off.
Exactly. To hit the headline numbers first, the S&P 500 finished down about 0.3%. The Nasdaq 100 was hit harder, down about 1 and a bit percent. And the Russell 2000 actually finished up, roughly 0.3%.
That split, tech down, small caps up, is the narrative in one line. Money pulled out of the momentum and profit names and went into cyclicals, utilities, and some value-oriented spots.
Yeah, that tracks. The most visible drag was mega-cap tech, led by a tumble in NVIDIA, and that amplified the Nasdaq weakness.
NVIDIA had been on a run for weeks, and yesterday you saw profit-taking and an intraday reversal. That's the kind of move that can make a tech-heavy index look worse than the broader market.
Not a great day for chip and cloud names. But at the same time, utilities and parts of energy, like renewables, found buyers.
Right. Utilities showed strength, especially companies tied to solar and energy storage projects. Analysts pointed out that those businesses can offer more defensive earnings visibility when rate-sensitive growth stocks are under pressure.
And industrials were another bright spot. New manufacturing investment headlines helped lift large-cap industrials and some mid-cap supply chain names.
Materials and miners also outperformed as commodity-linked names benefited from a bump in real economy demand indicators. So it wasn't a risk-off stampede. It was a reallocation toward economically sensitive areas.
Which is interesting because it ties into the macro backdrop. Inflation chatter resurfaced, with research notes even talking about an inflation storm brewing. That wording made fixed income markets reassess forward rate expectations.
If inflation looks stickier, the Fed will have less room to cut rates, or they could stay restrictive longer. Markets reacted as if rates could be higher for longer, and that dynamic tends to punish long-duration growth names.
So the story becomes, growth names, especially those with earnings far out, get hit harder when the discount rate rises. Cyclicals and commodity-exposed names are comparatively more resilient. Analysts noted that pattern repeatedly yesterday.
There was also a regulatory angle. A report said Apple didn't make an AI tool comply with new EU rules, and that headline added pressure on big tech more broadly.
Regulatory headlines can create pain for companies that are central to the AI narrative. Apple got clipped on that, which fed into the sector-wide nervousness.
On the roster of notable stock moves, Oracle stood out on the upside after strong earnings and positive comments around enterprise AI demand. That was one of those example wins for legacy software names tapping into the generative AI story.
Yeah, Oracle's beat and raise cadence has reignited enthusiasm among some analysts. Meanwhile, regional banks were a patchwork. Some names like Columbia Financial and Nicolette Bankshares got mixed reactions based on loan growth and deposit dynamics.
Industrials got a lift too. Companies like RBC Bearings benefited from positive analyst notes and big investment headlines that point to onshoring and CapEx trends.
Consumer pockets were selective as well. Think of niche names with stable demand. For example, companies tied to sports gear or specialty retail saw some buying after first quarter signals.
Also worth calling out, ETFs tied to utilities and renewables pulled in flows. That tells you money managers were repositioning toward defensive income and energy transition themes.
Short reactions.
Big move.
Not what anyone expected.
Yeah, absolutely.
Let's pivot to the macro and technical takeaways, because those are key for what could happen next.
From a technical angle, the S&P showed modest distribution after a period of chop and narrower breadth. The Nasdaq pullback looked like a retracement of momentum-driven gains, possibly setting up consolidation for growth names.
Meanwhile, the Russell 2000's relative strength suggested buyers were comfortable stepping in for domestic cyclicals at current levels. Traders will be watching moving averages and breadth readings closely.
Analysts flagged that a break below near-term support on the S&P would invite further downside momentum. But if the Nasdaq reclaims recent highs, then this pullback might have just been healthy consolidation.
So, what are the catalysts to watch heading into the next session? First off, Fed speakers and upcoming inflation prints. Any hawkish lean-in commentary or firmer CPI numbers could reaccelerate rotation out of long-duration names.
Earnings remain huge, too. Follow-through in AI-related results will continue to move individual megacaps and the broader tech complex. Guidance matters as much as quarterly beats right now.
And geopolitical and energy headlines can shift flows quickly. Oil price swings or supply disruptions would re-rate energy and commodity-linked sectors.
Technically, traders will keep an eye on S&P and NASDAQ intraday support zones and whether the Russell 2000 keeps outperforming. Momentum indicators suggest markets will need fresh catalysts to extend a tech rally.
Quick stop on crypto. There was renewed talk about tokenization, more institutional pilots, product launches, but also regulatory and operational risks. Analysts describe the conversation as constructive for long-term adoption, yet volatile near-term.
Right. Tokenization is an interesting structural story, but the near-term picture still includes policy uncertainty and operational vulnerabilities. So the excitement comes with caveats.
Let's recap the big stock-specific headlines in plain terms. Nvidia tumbled and was the headline drag. Oracle jumped on strong results. Apple suffered from an EU compliance headline. Regional banks were mixed. Industrials and certain consumer names showed selective strength.
And on the sector level, technology and communications lagged, while utilities, industrials, materials, some parts of energy, and select real estate names outperformed. That mix paints a picture of selective rotation.
One more short reaction.
Rotation, not panic.
Exactly. Final takeaways. Clear and simple. 1. Yesterday's action looked like profit-taking in mega-cap tech and a reallocation into cyclicals and defensive, rate-sensitive names. 2. Inflation chatter and regulatory headlines were meaningful drivers and could continue to swing risk appetite. 3. Technicians and traders will be watching support and breadth. A small break could turn into more momentum, while a reclaim would make this look like a healthy consolidation.
And remember, analysts note this is an environment of higher-for-longer policy risk and sectoral reallocation. That's market analysis, not investment advice. We're sharing what the data suggests, not telling anyone to buy or sell anything.
Good reminder. Investment disclaimer. We're discussing market moves and analyst observations purely for informational purposes. This is not personalized investment advice, and it's not a recommendation to buy, sell, or hold any security.
All right, that's our wrap. If you liked this format, tell us. If you didn't, tell us too.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. See you next session.